So we really like that. We like, of course, that it's real estate, it's cash flowing. You don't need a degree from an Ivy League school to run and operate a
Yeah.
self-storage facility. I mean, look, there's
Yeah.
lots of nuances and special things that need to happen, but it's not the most complicated business model in the
Yeah.
world.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have Tom Dunkel. Tom brings over 28 years of real estate finance and investing experience to his position as Chief Investment Officer. Working alongside his world-class team of professionals, Tom makes it his mission to find great investment opportunities for his clients while helping them meet their wealth-building goals. Since launching a full-time career as a real estate investor in 2006, Tom has raised over $65 million in private money across three asset classes: self-storage, short-term rentals, and distressed mortgage debt. Prior to investing in real estate, Tom worked in mergers and acquisitions, closing over $1.2 billion of deals in aerospace, IT services, software, and logistics. Tom lives in Wayne, Pennsylvania, and enjoys golfing, hiking, and playing guitar. As an average investor and lifelong learner, Tom is actively involved in organizations including Self Storage Mastermind. He's a Raise Masters coach and was recently named a Marquee Who's Who'd honored listee. And today, Tom's going to share his knowledge and his SAFE method that you can use in your due diligence process. Tom, great to see you again. How are you?
Hey, Chris, I'm doing great, buddy. It's great to be with you and all the listeners today. Looking forward to our chat.
Yeah. I'm excited. We're gonna be chatting a little bit about your methodology on how to evaluate investments. Um, but we're gonna get to that in a little bit. We're gonna talk a little bit about the state of the economy here after the election. Also talk about kind of
Sure.
where we see the real estate markets going. And people can look back and say, you guys are idiots or you guys were geniuses. And
That's
um,
right.
and
That's
it's
right.
on any given day, just flip a coin, and I'm either a genius or an idiot according to my family. So, but Tom, if you don't mind,
Right.
share a little bit more with the audience about your background and how you got to where you are today.
Sure, sure. Yeah, we'll do. And just a quick personal note before we get into that.
Yeah,
I know you're down there in the Asheville area. You guys
yeah,
had that awful storm about a month ago. Just want to let you
yeah,
know my thoughts and prayers are with
yeah,
you and Bryce and the other folks down there in the Asheville
yeah.
area. Just horrendous,
Yeah.
horrendous damage down there. So I hope you guys are doing
Yeah.
okay.
Yeah, thank you for
Uh,
that. And it's interesting. The devastation is really heartbreaking, but you really see, and I saw the community come together afterward. And
awesome.
especially in a year where you have an election and you have people kind
Hmm.
of going back and forth. I'm on this side, you're on that side. It was like all that went away. And it's a
Hmm.
shame that it takes a disaster to have that occur,
Mm.
but it
Yeah.
was it was really really heartwarming and really
Yeah.
I won't say restored my faith in humanity because I hadn't lost it, but it really gave me a boost when it came to that. So thank you for saying that.
Yeah, yeah, that's great to hear. But yeah, I'll keep it punchy, and we can drill
Yeah.
into more specifics later if you want. But yeah, I got out of business school and went into the aerospace industry where I was doing mergers and acquisitions for a company that was growing aggressively through acquisition and kind of repositioning itself. This was at the dawn of the internet era, and
Yeah.
so there was just a lot of amazing new technologies coming out, and so surrounded by some amazing people, Harvard MBAs, Wharton MBAs, ex-fighter pilots, astronauts.
Cool.
And so it was just an amazing environment to really cut my teeth on deals, finding good deals, doing the due diligence,
Yeah.
doing the modeling and the projections,
Yeah.
and getting the financing together because we were doing big deal. These were $50 million acquisitions, $120 million acquisitions, and so we were going to private equity firms, Wall
Yeah.
Street private equity firms, and working with big banks and some people might not realize this, but banks, if you go to a bank and you're getting like a huge loan, like a $140 million loan, they actually syndicate it out. I know probably
They split it
your
up. Yeah.
investors and
Yeah.
the listeners are familiar with an equity syndication, but
Yeah.
when you're doing big commercial size, deal, institutional size deals like that. They actually syndicate out the debt piece to different banks. So anyway, so I learned a ton, uh, worked with some great people, and then, from there, just sort of continued to build on that for the next several years in corporate life until 2006 when I got fired from my corporate finance job. And so it's a whole story, but
Wow.
that was
Yeah.
really the kick in the pants I did, Chris,
Yeah.
to really go out and do what I had been wanting to do for a while, which is go and do my own thing. And I wanted to,
Yeah.
build my real estate empire. But you've got a wife and two young kids at home, and
Yeah.
you've got kind of the golden handcuffs. You got a nice
Yeah.
salary. I was a vice president at a publicly traded company, so I had stock
Yeah.
options, and so it's kind of hard to break away from all that. But when
Yeah.
it happened to me sort of forcibly, I was
Yeah.
like, all right, this is my chance. So. Of course, 2006 wasn't the best time to get into real estate.
Yeah, I was gonna say,
So I
man, that
learned.
was like you could say is a great time. I mean, that was like the peak in '06, '07.
Yeah,
Yeah. Yeah.
exactly. So, I learned some hard lessons those next few
Yeah.
years because, of course, even though I had a great education, great training,
Yeah.
going out and being an entrepreneur and trying to build a team,
Yeah.
do some of those things, and in a market that, frankly, I hadn't been in before. I hadn't bought a house except for the one that I lived in
Yeah.
prior to going into residential estate, doing fix
Yeah.
and flips and picking up some rental properties and doing some wholesaling.
So were
Um,
those your first
so.
what was your first type of deal?
Mhm.
Was it residential?
Yeah,
Yeah.
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 I tried to wholesale a property in Philadelphia, and it didn't go well. But
Yeah.
anyway, so everyone has those stories. But
Yeah.
yeah, so learned some hard lessons over this next few years. But I was determined to kind of get out. It was not going back to corporate
Yeah.
life, and so through going to some real estate networking events, I started learning about distressed mortgage debt.
Yeah.
And through those investor meetups, I also met my business partner Joe Downs. We've been business partners about 15 years now, and so we started out in distressed mortgage debt, and people thought we were crazy. We were charged off, defaulted second mortgages on
And this
residential real
was
estate.
and this was what year?
2009,
Yeah, so this is
2009.
great because we
Yeah.
got in that space a little bit after that, and
Hmm.
we've had some people on the show talking about this. I think
Hmm.
it surprises a lot of people to hear that. Wait a minute, you can, there's this market where mortgages are sold, which is very common
Hmm.
in the banking
Hmm.
space, but
Yeah.
then there's the non-performing note space, and then there's the
Hmm.
secondary non-performing note space. So
Hmm.
just share a little bit about what that is, and also, I can
Sure.
probably guess, but tell me kind of what you were paying on the dollar for those types of non-performing seconds back then.
Sure, sure. Yeah.
Yeah.
So, uh, it's not as common anymore, but back in the, late 90s, early 2000s, there was a pretty popular structure out there where they'd call it like an 80-15-5 or
Yeah.
an 80-10-10
Yeah.
kind of mortgage
I think we
structure,
did
right?
an
So it'd be
80
an
10
80,
10 on our first my first property back
right.
then. Yeah.
So
Yeah.
there's an 80% first mortgage, a 10% second mortgage, and then the property owner, the purchaser, puts up 10%. And so
Yeah.
there were a lot of those second mortgages,
Yeah.
written back in those days. And
Yeah.
and then unfortunately, in good times and in bad times, or bad times and in good times,
Yeah.
sadly, sometimes people will have a life event, they have a health issue or a divorce, or they lose a job, or something happens where they're just not able to pay their mortgage anymore. So they stop paying, and the bank, the loan servicer, they're not very entrepreneurial. Their box in dealing with a
Yeah.
borrower is about this big. It's tiny.
Yeah.
And so what's happening is that loan gets charged off, they call it, which
Yeah.
is, just sort of set aside, which is bad for the bank because the
Yeah.
banks have regulators, right? And the
Yep.
regulators don't want to see banks have a lot of charged off loans.
Yeah.
And so what the bank does is they clean up their balance sheet by selling those loans, those non-performing loans, out into the world. They sell first, they sell seconds, they sell home equity lines, they sell even business lines of credit. Like you said, once you get in this world, you start seeing, and then,
Yeah.
credit cards, of course. Yes, there's all kinds of debt out there that you can
Yep.
buy. Um, but when we started looking at this opportunity, we saw that there was a huge price discrepancy between, what a non-performing first mortgage sell for versus a non-performing second. You're still secured by the property
Hmm.
in second position. A lot of people don't know that. You can foreclose from second position. I mean, you have to deal with the first, but you
Yeah.
still have some leverage there. You still have some ways to monetize that loan. And but the you can buy them at such deep discounts. I think our first this was when we were buying from an intermediary. Now our company has grown. We're buying direct from the banks, getting really good
Yeah.
pricing. But back then when we were buying from an intermediary, we were paying anywhere from maybe 20 to 30 cents on the dollar
Yeah.
for a non-performing second. And so, if you're buying a $50,000 second for 10 grand or 15
Yeah.
grand, it gives you a lot of room to work with the borrower. And,
Yeah.
we got into the paper business because we didn't want to own the brick. So our absolute last resort was foreclosure. In
Yeah.
fact, over 15 years, I think I can count on one hand how many homes we've actually foreclosed
Yeah.
on. So, we'll work with the borrower to come up with a payment plan that works with their current financial reality, their
Yeah.
whatever it is, it's changed
Yeah.
from when they were originally underwritten. So we were able to build a really nice business there, and I think we just surpassed $58 million of revenue in that business for the
That's
past
awesome.
15 years, which
Yeah.
which is pretty cool for a couple of guys and a laptop, and we have like two support people in that business.
Amazing. I love it. Yeah, and I
Yeah, it's
think
pretty cool.
the numbers, just to break it down for you if you're listening today, if you take, like you said, if you take a $50,000 second, you pay 10 grand, you know,
Mhm.
even if you cut the payment in half for that individual or a quarter, you can still be making really good money on that and help that borrower out. And a lot of the
That's
borrowers in
right.
our experience that we dealt with, some of them didn't even realize they still owed the money because
Mhm.
they had gone through something or, if it's, they want to get that worked out. They just didn't have the means to do it. And the bank didn't have the means to do it with their structure, like you said, because they had that small box. So I think
That's right.
one of the cool things about the business is you can make money, but you can also help these individuals out by being more
100%.
creative than a typical bank structure. And you learned a lot, Tom. I
Mhm.
love I saw my parents both lose their jobs in the early 90s during the savings and loan crisis. I was in
Mhm.
business school when 9/11 happened and watched that business
Mhm.
cycle with the internet. Watched
Mhm.
08, 09, that period. And I
Mhm.
started to study the real estate cycle, which is one of the reasons I was excited to have you come on
Mhm.
today,
Mhm.
because as we talked, the real estate cycle it goes in these booms and busts, and
Sure.
what
Mhm.
share a little bit about what you have seen, how you kind of were able to zoom out, because a lot of people think, oh, real estate just
Mhm.
goes up, it goes up and to the right. It goes up 3% a
Yeah.
year, 5% a year. In some cases,
Yeah.
people are seeing 10% a year over the past several years, and they don't realize that
Yeah.
real estate, like the stock market and other assets, does go up and down, and it's largely influenced by credit and banks and those sorts of things. What's your take on that?
Sure. Sure. Yeah, 100%. You mentioned 9/11. I mean, that
Yeah,
was
yeah,
I was in investment banking back then, and I had a I had a bunch of internet stocks that
yeah,
years later after 9/11, the internet bubble burst. So that was really
yeah,
my first experience with a
yeah,
with a big bubble. Although I do have to say, I remember the 1987 stock crash. I was
yeah,
just
yeah, yeah.
I was it was in college, but
Back in
so
the
I guess I had seen over the years that there are these ups and downs and these
yeah,
swings and different asset classes, different markets, and so sadly, I guess I didn't. When I went out to do my own thing in real estate, I was just, focused. I was like, and I'm going to do this. I'm going to buy this stuff. It's going to be great. But, had I, learned a little more from my past, I would have probably gone maybe a little more cautiously. But you know what? Things all happen for a reason. If I
yeah,
had gone through that crash, I wouldn't have found distressed mortgage debt and built this great business, and which has allowed us to get into other asset classes
yeah,
too, like, hard money lending and self storage. and short-term rentals. But anyway, yeah, that was a big learning experience coming out of that, and I hope people out there have watched the movie The Big Short, because that
Yes,
was
great movie.
really what was going on. A
Yeah.
lot of people saw that big crash coming, and
Mhm.
and it was sad that they felt bad, but they made a gazillion dollars on against the U.S. housing market.
Yeah.
But it does go in cycles, and that's a good thing, because I feel like right now we're kind of we're at a tough spot in the cycle.
Yeah.
The last year and a half, 2 years have been pretty tough with interest rates running way up,
Yeah.
and that's thrown a lot of wrenches in the real estate market.
Yeah.
But you know what? I feel like right now, like if looking back, trying to learn from the past, I think people who started buying properties again in 2010, 2011, when it
Yeah.
was tough, right?
Yeah.
The lending markets hadn't really loosened up yet, and it was tough to find
Yeah.
investors to
Yeah.
jump in with you
We
on a
couldn't get a
deal.
loan to build a house. We were building homes um,
Yeah,
until 2013. Took 5
yeah,
years
yeah.
really to get to the point where banks would lend on that.
Hmm.
It's crazy.
Yeah.
Yeah.
But yeah, if you can manage somehow to
Yeah.
get some deals done during those tough
Yeah.
times, those are gonna be
Yeah.
big winners.
Yeah.
But real estate has never been a get rich quick kind of thing.
Yeah.
It's only a longer term kind of asset,
Yeah.
and if you understand the cycles, you can certainly build out a nice portfolio, that
Yeah.
including different kinds of real estate. And that's what I love about it too, is
Yeah.
the stock guys, they talk about diversification being growth and value, or large cap, mid cap, small cap. That's their idea
Yeah.
of diversification.
Yeah.
But when the market crash, there's a correlation of one
It
all
all
across
goes
all of
down.
those.
It all goes
Yeah,
down.
but
Yeah.
if you're in
Yeah.
a but if if you're in an apartment in Houston, or you're in a self-storage facility in
Yeah.
Asheville, North Carolina,
Yeah.
we actually just sold a facility not far from you down there. But
Oh, cool. Yeah.
yeah, but you are then truly diversified.
Yep.
Diversified markets,
Yeah.
diversified operators,
Yeah.
diversified asset classes. That's diversification.
Yeah. Absolutely. And yeah, I think that's one thing, as we've just had a gentleman on, Mark Miller, who manages basically the Hilton family office. And we
Hmm.
talked about this. They're putting, say, a quarter in the stock market, quarter in private equity, real estate, those sorts of things. They're splitting it
Right.
up. And what's
Yeah.
diverse to the average retail investor of, say, 60-40 portfolio in stocks and bonds,
Yeah.
that's that's not even, that's like just having the meat on your
Mhm.
plate for dinner. It doesn't even have
That's right.
any of the other stuff, which
That's right.
that's one thing that I think people forget. Like, we're talking about hedge funds in a podcast last week. Hedge funds are designed to zig when the market's zagging, and
Mhm.
not every asset class is always going to go up. So, like you, Tom, we're invested in different asset classes in different markets. Private lending has done really well here the past couple
Mhm.
of years as interest rates have gone up, and
Mhm.
we've been able to kind of effectively become the bank, which is a good time. What are some things that you can give the audience in terms of tools to protect against the downside when the market does go down? Aside from diversifying, what are some things that you take into consideration? Are you a high income business owner or professional earning two, 300,000 or even more a year, but still feel like you're living paycheck to paycheck? Are you comfortable working until you're 65 or 70 to retire? Or do you want to achieve financial independence and live life on your own terms? You could join myself and Matt Four and learn how we both became financially independent in our early 30s. We will teach you how to make, keep, and grow your money, teaching you strategies to maximize your earnings, keep your income that you've earned through tax strategy and legal structures, and ultimately teach you how to grow it by determining your personal investing strategy, as well as teach you how to analyze investments so you can grow your passive income to the point to live life on your own terms. Our coaching clients reliably do this in 7 years or less. To learn more, check out our coaching program at nextlevelincome.com/coaching. That's nextlevelincome.com/coaching.
Sure. Well, if we over the years have learned some lessons. We've had
Yeah.
some successes, but we certainly
Yeah.
learned some lessons. And it really, to me, because, not only am I an active, investor myself,
Yeah.
with a storage company and now, starting a fund, but,
Yeah.
I also invest as an LP in other people's
Yep.
deals. And so, the big thing I start with is the sponsor. Like what is
Yeah.
the background of the sponsor? Because at the end of the day, if I want to sleep well at night, I want to know,
Yeah.
like, hey, Chris is a good dude. He's got this
Yeah.
great track record.
Yeah.
He's in all these asset classes. He's a smart guy. He's got the receipts, as they say now.
Yeah.
So he's a guy, that's picking the jockey, not the horse, right? So,
Yeah.
so actually, we've developed. If you want me to go here now, a safe method.
Yeah.
We've
Let's
actually
let's dive
developed.
into it. Yeah.
Yeah, we've developed. So, we've been investors. I've been a full-time investor for going on 19 years, or yeah, 19 years. And over the years, looking at different deals, different classes, different operators, I think what we learned is that you got to really um, dial on the sponsor. A lot of investors jump straight to the deal, right? What are the returns looking like? Is it an apartment? Is it self-storage? What is it? But we developed this really, it's a due diligence template. It's kind of a framework,
Hmm.
which has become really helpful, because especially for newer investors, maybe they've only been in stocks, bonds, and mutual funds,
Yeah.
and they see that people are doing well, investing in multifamily
Yeah.
apartments or other asset classes, but they're just not sure how to get started. So this framework, we call it the SAFE investing method, and SAFE is an acronym. Investing isn't safe, but if you use the SAFE method, you can de-risk and
Like that.
hopefully,
Yeah.
not hurt yourself. But
Yeah.
S is for sponsor, like we just touched on. Get to know your sponsor. Take a little time. Don't just get an email or see an ad on Facebook or something and just throw 50 grand at it because it looks good. You got to
Yeah.
have a call with the sponsor. If you're close to them, that's even better. You can
Yeah.
sit with them personally, and you really kind of get to know them. And is it like Joe Syndicator at gmail.com? And it's a huge red flag right there. It's like, no, you want to know they have a team behind them. They have a track record, which is super important.
Yeah.
So the ebook that we have has a whole list of questions, certainly not exhaustive, but a list of
Yeah.
questions just to get your brain going in the right direction, questions to ask about the sponsor. A is for asset. So what is it exactly that you're investing in? Can you explain this investment to your mother or to your children, or so that you need to have that level of understanding about it, that you can explain it to somebody else. So if it's a multifamily property in Atlanta, is it okay? Well, is Buckhead? Is it in Marietta? Where, and what's
Yeah.
happening in that specific market? What are the macroeconomic drivers there? Is the population increase? What's the crime like? So you want to look at all those kinds of things when you're looking at your asset. And then F is for financials. So what do the financial projections look like? Is it a hockey stick? Are they promising,
Yeah.
move? That's a red flag. And what are the tax implications? What does this investment mean to your personal investment portfolio? Is it going to make you too overweighted in self-storage, or some other asset class? And so you need to, consider those financials. And then E is for exit. How do you get out of this thing? It's not like you can go to
Yes.
schwab.com and click, click, click and sell your position in a
Yeah.
Bell Storage Group self-storage syndication. It just doesn't work that way. So as an investor, you need to go into these eyes wide open, knowing how long your capital is going to be tied up, what needs to happen for you to get your capital back, and what's going to drive those returns and those kinds of things. And has the sponsor delivered on those kinds of financials and exits in the past? So, they all kind of tie together, but the ebook just gives a list of questions in each of those categories that just hopefully help people sleep better at night,
Yeah.
knowing that they've asked some good questions. They understand the sponsor, they understand the asset, the financial projections, and how they get out of it. I think it's a good way for new investors, especially to get in, but also seasoned investors to just, sometimes you get lazy when you've been in it for a
Yeah.
while and, you just sort of skip past some things.
Yeah.
But I use it personally as a framework to get started when I'm talking to a new sponsor, for example, or learning about a new asset class.
Yeah. No, I think it's terrific. And what's the best way for people to get that? We'll put that in the show notes here, Tom.
Sure, absolutely. Well, if you I would say if you DM me on LinkedIn, you can find me on LinkedIn, Tom Dunkel. I think there's only a couple of us out there, Dunkel. But yeah, if you DM me there, I'd be happy to respond with the ebook. And then also, any other questions you might have, happy to jump on a call or, share whatever I can with you.
Yeah.
That's kind of where I'm at in my career, Chris. I'm like,
Yeah.
I've accumulated so much great knowledge and experience and stuff.
Yeah.
I'm trying to find ways to just, share with the world out there, the cool stuff that I've learned and
Yeah.
along the way. So
Yeah,
hopefully I
we
can
love
help
it.
someone else get
And
further faster.
absolutely. And that's what we're all about here. So, Tom,
Mhm.
thank you for that. We're going to make sure that we have that in the show notes. You talked about, coming out of your VP role. And I think,
Mhm.
I'm going to say this, it's going to sound kind of easy coming out of my mouth, but I think sometimes it's easier when you're forced into that role because it's so hard when you're working for a big company
Mhm.
and, you have this title. And I'll never forget, I was actually
Sure.
interviewing for a VP role and I started thinking about it. I looked at my life vision that we work with our coaching clients
Mhm.
on. I said, do
Mhm.
my kids really care what's on my business card? And I got tied up. It's like, oh, get the
Yeah.
VP, you're
Yeah.
traveling here, you're going there, you got,
Yeah.
the Marriott platinum status or whatever it is. And,
Right.
you
Right.
know, and then you realize I just want to be home with my boys and have a nice dinner. Um,
Yeah.
so, if you're struggling and you're like, oh, I want to
Mhm.
make this move, take it from me, take it from
Mhm.
Tom. Like build a pathway, find somebody that can help you build that pathway so you don't get
Yeah.
stuck in those golden handcuffs. And Tom, you started at a great time when it came to
Mhm.
distressed debt. You
Mhm.
talked a little bit about storage and the fun that you have coming up. Please share with the audience
Mhm.
before we wrap up today. What is it that you're doing now at Bell Rose Storage Group, and what are the acquisitions and assets that you're most focused on right now during this part of the real estate cycle?
Yeah. Yeah, sure. So we started Belrose Storage Group about 5 years ago. We had this great run in the stress mortgage debt business,
Yep.
but it's very volatile.
Yep.
It's a very up and down kind of business, especially because we're buying direct from banks, and so if the bank doesn't want to sell,
Yep.
there's not a lot of inventory that we can accumulate there. But so over the years, we've been looking at different asset classes, try to diversify into, build another business or two, and so around about 2017, 2018, we started looking at self storage, and it checked a lot of boxes, right?
Yep.
Because it's a very steady asset class, good times and in bad.
Yeah.
It's, people need storage, right? So we actually have a chart in our investor deck that just shows self-storage occupancy across the country. It just sort of meanders between like 80 and 90% for the last 40 years. And so, if you think about what's happened the last 40 plus years, it's like, we've had booms, we've had busts, we've had wars, we've had pandemics, we've
Yeah.
had all kinds of crazy stuff, but storage maintains, pretty
Yeah.
steady use. Um, so we really like that. We like, of course, that it's real estate, it's cash flowing. You don't need a degree from an Ivy League school to run and operate a
Yeah.
self-storage facility. I mean, look, there's
Yeah.
lots of nuances and special things that need to happen, but it's not the most complicated business model in the
Yeah.
world. I mean, we use the latest and greatest technologies and that kind of thing in that business.
Yeah.
Make sure we're staying on top of best practices. But it's a pretty simple and pretty lean business model. So we really like that cash flow. And it's becoming more and more adopted. Chris,
Yeah.
the market penetration
Yeah.
for self-storage use is just steadily
Mm.
increasing.
Yeah.
And so, those are new customers coming on board, and
Yeah.
creating demand and all that good stuff. So
Yeah.
so we started buying facilities and put the team together in 2019. So, we were going to the conferences and join
Mm-hmm.
the mastermind team together in 2019, bought our first facility in 2020, and now we're about to buy our 19th facility. So we've
Terrific.
had a good run there. It's been challenging for
Yeah.
sure.
Yeah.
We got started when things were,
Oh, yeah.
pretty,
Ripping. Yeah.
they're ripping for sure.
Yeah.
But the last few years, we've really had to hunker down and focus hard on
Yeah.
operations because, of course, we don't control interest rates, we don't control the debt
Right.
markets, or
Yeah.
we just focused on what we could control, which is just making sure we are running these facilities as best as we could.
Yeah.
And you mentioned about um, cycles and whatnot.
Yeah.
So, we could see the writing on the wall, the real estate was going to be coming down. And so we started using less and less leverage
Yeah.
as we were acquiring these facilities the past few years. So we actually had a bank on a deal that we bought out in Kentucky. They said, "Hey, really like you guys. We'll do 80% loan to value." And we were like, thanks, but our model works really well at 75%, so we'll stay there. And we're
Yeah.
glad that we did, because then, of course,
Yeah.
the market kind of came down and
Yeah.
softened. But yeah, and then another deal, we were only at like 53% loan to value. So
Yeah.
that's a way
Yeah.
that we, protect ourselves, protect investors, and
Yeah.
just try
Yeah.
not to get too out over our
Yeah.
skis.
Yeah. No, I love that. And that's one of the three tenets, in my opinion, which is, reasonable long-term debt that aligns with your timeline, your hold period, have
Hmm.
reserves that are backed up, and make sure it's a
Yep.
cash flowing deal. So Tom, that's great. If investors want to learn, I know you already shared your contact information, but just one more time, talk
Sure.
about how they can learn more about Belrose Storage Group and where they can find out about you.
Sure, yeah. You can go to belrosestoragegroup.com. And again, you can find me on LinkedIn, Tom Dunkel on LinkedIn. And excited to share too, Chris, that I'm at the very beginning stages of launching my own fund. I've met some amazing operators over the years, like our mutual friend Bryce Robertson, and
Yeah.
my multifamily guy in Atlanta, Steve, and the guys at Lone Star. There's so over the years I've created these great relationships, and so
Yeah.
I've been investing with them, and so now I'm going to be doing a fund to just invite investors to invest with me and take advantage of my relationships and my network that I've been able to build over the past
Yeah.
you know 19 years, banging around out here in the real estate world. So yeah, so people can get with me on LinkedIn and stay tuned for that big announcement coming soon.
Love it. Well, check out Tom at belrosestorategroup.com. DM him if you want a copy of his ebook to learn about his SAFE method, where it can help you walk through your due diligence process on your investments. And Tom, thank you for sharing all your knowledge here and having a little fun chat with us today at Next Level Income.
Awesome, Chris. Great to be with you, buddy.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.